Welcome to the Labor Day edition of the Death Burger videos. This is John Galt speaking. Special edition, focusing on the major indices. It is a very bad situation evolving in our financial markets worldwide, and everyone's trying to make a relation to 2008. I'm going to blow that away. A reminder, the information contained within this video is for entertainment and informational purposes only. Any financial decisions made by using the material within this video should only be used in consultation with a financial professional, Galt.wmv, and the host, John Galt, cannot be held liable for decisions made using the information provided. For more information, see the full disclaimer at www.johngaltfla.com. Well, somebody's been having fun with the markets, and obviously it's somebody who, well, has got relations with our friends at the Fed, possibly, or even world governments. Who knows? But what's going on now was broken down earlier when I warned about a stock market crash in June of this year in a prior video. Right now, we're really in the eye of the storm. We haven't broken down to the all-time lows of 2009. We haven't had a total destruction according to the statistical release, but we're right now going back into the outer eye wall of the hurricane, which is usually the worst part of the storm, especially if you're in the highest impact area. For example, the Dow Jones Industrial Average. You see this one-year chart. We had the nice rise over the spring going into May. And then May, just like May of last year, started to collapse and break down. And it looked like we were going to have a massive collapse. But they caught it before the 200-day moving average, turned it up in early June, providing some false hope. But you have a nice double top right there in July. And then the bad news started to roll into the markets from late July through August with huge volume spikes. And of course that resulted in the proverbial, you got it, yield death cross, the technical formation ignored by many, adored by a few of us. That death cross, which is circled on this chart, is where the 50-day and 200-day moving average cross, and we have shattered the 200-day moving average and the short-term 50-day moving average severely on the Dow. You're going to see this pattern repeated on indice after indice. What's worse is the 200-day moving average is getting ready to roll over and start moving down also. When it does, they'll be chasing each other just like 2008. The Dow Transports, same pattern, did not have the double top, actually made a higher high in July and then failed. More or less of a head and shoulders, which the 50-day moving average traced right through. We had the death cross, it has collapsed, and it has also broken down severely. So for all the Dow theorists out there who are looking for their buy signal back in July, you did not get the confirmation, as many of the experts in the arena wrote about and said it didn't happen. NASDAQ, similar but not quite same pattern. You had the double top pretty much in July, but it compressed rapidly. Had some flashes of recovery through news from Apple and some of the other large cap stocks. But as you can see, when that death cross occurred, that was pretty much all she wrote. She tried to rally, failed, fell back, retested the lows, held the lows, came right back up in into the end of August to the first part of September, and then boom! Based on this, from the new high, new lows, once we break the 2300 level, I think this sucker is just going to keep on going downtown, is emphasized by this dramatic arrow there that I overdrew on the screen. And 2000 is going to become your ultimate support level for the NASDAQ. Once 2000 breaks, all bets are off. New York Stock Exchange, darn near the same pattern. Huge volume during the sell-off. Stair-step decline, close to a miniature double top there in July. We are a long way from the early spring highs of April. Market broke down severely in the last three-week sessions. It needed to recover and at least try to get to the 50-day moving average. It failed. They were looking for a W bottom to retrace. It did, but did not hold. It's reversed, and guess who's looking for more trouble? You got it. This guy's back again. You go to the small caps, the Russell 2000. What's disturbing about this pattern is the rapidity of the decline and the sizes of the decline. It started to roll over right after it failed to reach a new high for the year at 860, turned around, started to move down, did not even get close to a double top, endured the death cross in early August, slammed down to a new low, Right now, all indications are we're going to break to a new low, and I think 600 will be shattered in this next move down, followed slowly soon thereafter by 500 being supported on Russell 2000. There's your key indicator. The broader Wilshire 5000 looks almost identical to the S&P 500 or the NASDAQ. You can just fill in the names, except the NASDAQ held up a little bit better. The Wilshire is a much broader index. I brought it up just to give you some perspective. When you see it breaking down like this, when you see the slicing through the 50-day, slicing through the 200-day, the death cross, and then the collapse, failure to break out of the W pattern and retest the 50, it's all over. Now, the big one that I watch, the S&P 500, the big boys. When you look at this chart, you see the similarity to all the other ones that we've seen. This is a one-year chart. We never made it back to the 2007 highs, never made it back to the 2008 highs. We simply sat there and fell short. What's disturbing about it is the head and shoulders formation isn't so pronounced. It does look more like a double top. You see the perfect M, almost perfect M there. Then the collapse, the attempted rescue, then boom, the death cross becomes very, very visible in August, just like the other charts. What is disconcerting about this death cross, this could be one of those 20-year death cross. This could be the culmination of the mega bear market. This could be the one that says, okay, we made a giant head and shoulders formation years ago, with this being the right shoulder going all the way back to the early parts of this decade. We'll see what happens here, of the last decade I mean. We'll see what happens, but if once it breaks down and does not get above the 50-day moving average, the 200 rolls over in that area, that action you see right now, once it breaks through that, there's nothing to support it. Right now, the key level is still 1101, but at 1127, if we fail that again this week, we will retest 1101, no matter what Obama says on Thursday, and I think that puts 1010 to 1000 in play. Those are both just psychological support levels, not that technically important. We get down to 991, 993, that's where it's going to break down, and that's why in this chart I say it's going to break down. I think we're going to go right back to about 993 in mid-September, get another bounce, another attempt to go rally towards the 50-day moving average on the false hopes being built up and leaked out by the Federal Reserve. That breakdown, though, has the potential to hold for a long time, and if we break below 1,000 with substantial volume, as the first breakdown occurred in August, we will parallel 2008, and we won't get above 1,000 for several months. When you start to look at the overseas markets, the DAX is the best example of a total breakdown in a market. Look at the diving 50-day moving average after the death cross. Look at the failure to sit there and confirm the original top earlier this year. Look at the total breakdown, though, and this is why I think this is the future for our markets. You see the breakdown below the original lows in August. Each successive low has been harder hit with more volume and more pronounced, closing at the lows of the day almost every time. The CAC 40 in France, a similar situation, although we haven't broken down to the all-time lows. We're about to face that probably in this week's sessions. France is in horrible condition with rumors about their banking system. Never even got close to an all-time high. The death cross occurred long before it did in the United States markets back in July. The foreign markets were telling us what was going to happen in the U.S. markets, and I think they're going to tell us what's going to happen in the U.S. markets again with the FTSE, the CAC 40, and maybe even the FTSE 100 leading the way, although if it's got to break a little bit down a little bit more, it's got another good 100, 200 points that the FTSE 100 has to break down through from its current level. It needs to get down around 47, 4800 to really provide a conclusive bottom. If it closes around 47, 4800 this week, that could give us an indication where the U.S. markets are going. All of the markets in the major of the major indices in Europe have broken down severely, as you can see, after their death cross. Switzerland is no exception. Switzerland was the canary in the coal mine, and I missed this. I saw it, and I didn't even think about it. The death cross in Switzerland occurred back in April. It attempted to cross back over in June, failed, and then broke severely. You have a declining 250-day moving average. Right now, Switzerland has bounced hard off of a very low figure, around 4,700, but odds are it's going to come right back down and retest it because the Swiss currency is about to become the safe haven currency one more time. And another market, similar situation as Germany, Austria, broke in June, severe break in the 50 and 200-day moving average, failed to even get close to recovering to the 50 in the last 3 weeks. I don't think we're going to see anything but another new low in this market, and that should be a warning as Eastern Europe breaks down. The basket case, the FTSE Milan MIB mark index, it has shattered everything, declining 200 and a declining 50-day moving average. Sharp declines. Right now, the 50-day moving average is around 17,162, I believe it is. I got to go look at that up at another time. Don't worry about it. It's irrelevant. It's not going to see it anytime soon. The market's breaking down further. It's becoming to behave like a pig, and the politics will take over and drive the market lower. Greece, the original grandfather of pigs, had the breakdown back in April, May, just like Switzerland, and that was your warning signal. Now, why is Greece so important? Look at the severity of the breakdown of this market. It has not shattered this all-time low set earlier, just several weeks ago in August. There were some big hopes put up there that things were going to get better and that they would bounce back up to the 50-day moving average as they had in two prior occasions. But look at what happened here from the highs. You stair-stepped all the way down to these lows in the 800s. Did not hold or attain the 50-day moving average when our markets broke, the European markets broke severely in June 1st, then July. Even though they were able to get the 50-day moving average twice in their bounces, it didn't this time. And look at what's happened over the long term. You've had a 50% crash since March of this year, for all practical purposes, from an intraday high of the Greek markets. A 50% crash. You've had the votes, the drama, you've had the occasional rallies on the austerity measures and belief that the Europeans were going to bail them out. But this 50% decline could be a precursor of what's going to happen to the rest of the European economies and eventually our own, which would give us a retest of 666 in the S&P. The Russians were doing better, although on extremely light volume. Very spotty chart, but look at the death cross. Looks like another confirmation that the Russian market, as I hit some of the periphery markets, by the way, as oil prices begin to crash, which they will, there will be some deflation exhibited in the system. Russia is going to roll over, and that market will come back down to hit some new lows, probably violating its 2008 lows when it's all said and done, and helping to sweep Putin into power. Using the Egypt market vectors, ETF, rather than the Cairo market indicators, which are somewhat unreliable. The Egypt market indicator investment that some people touted, oh wow, look how much better it's doing in June. It had a death cross back right after the Arab Spring started to rock and roll. Coincidentally, close to the time that Switzerland and Greece had their death cross, it has rolled over, it has crashed. Very little hope for recovery there. But let's go to a market which is supposedly a leader of the pigs, the emerging markets. That's Brazil. The Brazilian Bovespa had a death cross back in April. But what you can see is, after the crash of August, June, July, and August, it bounced up and looked like it was going to retain everything and look even stronger. In fact, here's where I've circled. You see at the very end of that, the last candlestick, that was a white one, shows that the market rose because they cut interest rates. Everyone thought, ha, brilliant. Brazil's going to recover. They're going to lead the world out of this economic morass, and everything will be fine. The problem is, it's a Band-Aid on a severed limb. The other indicator I circled was the red candle, a failure on the 50-day moving average, a declining 50-day moving average after the death cross back in March. This is a very bad indication. Major markets, Switzerland, Greece, Brazil, all saying death cross back in the spring, rolling over, crashing and burning. I think we're about to see a 50% correction in total from the highs to the lows of the U.S. markets. Stay tuned to my programs Monday through Friday, 7 to 9 p.m. on the Just Measures Radio Network. More information available at johngaltfla.com, where I'll be doing other updates on this. There'll be further videos coming out this week on currencies and the banksters, as I want to see what the breakdown on the banksters is in the days to come and as the markets move forward. For John Galt and John Galt, for the voice of Galt, johngaltfla.com. This is John Galt. We'll have another update next weekend and get you guys primed, because this looks like we're in the midst of the next great economic storm. We'll see you next week.